Last year I showed you how I hit $263,000 in stocks by age 25. But a lot can change in 365 days. My combined portfolios have now crossed $397,000. That is a $134,000 increase in a single year. Now, was that all gains? No. But did I deposit $134,000 of cash? Absolutely not. Actually, since my last update, I've contributed just under $44,000, so the rest of that was all capital gains and dividends. The overwhelming majority of this growth was completely passive, and it goes to show the compounding effect of investing in the market over the long term. Today, I'm going to show you which of my stocks caused this big increase, the dividends I'm earning and projected to earn in the future. I'll share future projections of how this portfolio could grow even if I add no new money. And since I'm recording this on Thanksgiving, I want to share what I'm grateful for and the strategy that actually helped me reach this goal. Now, to be transparent, this gain over the past year is not all due to me. The market has been on a tear with the S&P 500 around all-time highs, and year-to-date the index is up 16.28%. So I, like most investors, am riding the wave of the market. There has been and will continue to be sell-offs over time. Just in recent history, we had the COVID crash, we had the inflation, the interest rate hike, and tech sell-off of 2022, and in 2025, we had the April tariff sell-off. The market does not always go up, and it will continue to have sell-offs and potentially even prolonged crashes. But part of what's helped me is mindset. I don't panic sell in these downturns, I actually add and invest more. As an example, in 2025, my best investment was Google. I bought a ton during that April tariff sell-off. I wish I had even more. And that has been a great performer for my account. We'll talk more about that later. And what I've done that's worked is I live below my means, save a bunch of money, continue to invest consistently in the market, and even more during downturns. And likewise, I try not to get too ahead of myself when the market's hitting new highs, and I try and strategically add money and look for opportunities. I personally have not made money in the market trying to do it all quickly in some get-rich-quick scheme. I just consistently invest in high-quality businesses. And now I've built up a pretty good foundation. So with that said, let's dive into my full account. That'll be 3 different ones: my dividend growth focused account, my older non-dividend account, and then my Roth IRA. I'll start with my dividend portfolio, which I update every single month on this channel. And I've actually been sharing updates as I've grown this account from $30,000, now hitting an all-time high of $285,000. And this is in a traditional taxable brokerage account. And the goal is really just to focus on total return while building up a stream of passive dividend income. So I have a mixture of very high quality big tech companies with reliable growth and fantastic cash generating businesses with high cash flow dividend payers that I can nab at very attractive dividend yields. But I am not just yield chasing. I am looking for opportunities where I think there will be a high total return as well. And people often underestimate the high yield stocks when it comes to that. More on that in a bit. I've been sharing this account with you since 2020 when it was $30,000, and you've been able to watch me grow it every month along the way. You got to see all my winners and losers, and believe me, there were a lot of mistakes, but you got to watch me learn more about investing and refine my strategy. Currently, this account generates over $12,000 in annual dividend income, and this is a new milestone. That's about $1,000 every month on average. And right now I reinvest all those dividends to buy more stock, increasing my future income and ownership stake in these great businesses. But eventually this is money that I could just use as cash, take out occasionally, or use as my retirement income. But right now, and for probably many decades to come, I'm just going to keep that machine snowballing and reinvest all my dividends. My largest dividend payer by far is Hess Midstream, ticker symbol HESM. This pays me $7,200 a year, and I just started building this position up over the past few months, and I'm still slightly down on it overall. I've done a few stock analysis videos on it, and I will do an updated review soon. But everything here, it's not personalized financial advice. Do your own research before you make any investing decisions. Other holdings I have include the Altria Group. That pays me over $2,000 a year, and I have about a 10% dividend yield on cost for that because I bought it at a great deal. I've had this stock for about 3 or 4 years, and it's gotten me a 90% total return so far. So you can get good total returns with high yield stocks. My third largest dividend payer is MPLX. That's another midstream oil and gas pipeline. Pays me $1,200 a year. This is another one I've added in 2025, but lately I've been focused on HESM since it sold off a ton. I have a 16.8% total return on that. My other large dividend payer is ExxonMobil. I bought this during 2020 when energy stocks were on sale, got a 10% yield on cost. And this has been a huge winner for me in the market, 250% total return. And I have 34.3 shares just from reinvesting my dividends. But then you'll notice some of my lower income stocks, which are actually top positions of my account. That includes Microsoft, Alphabet, and Visa. With Microsoft, I have an 86.6% total return. I bought most of this in fall 2022. But but I've continued dollar cost averaging along the way. And the Alphabet's gone up a ton this year. In fact, it's responsible for $25,000 of those gains. I have a 97.87% total return, and that's just in this account. I actually own Alphabet in another one of my accounts that I'll talk about later. I also own Visa. I have a 39% total return on that stock. And these companies, they are lower yield. Microsoft's current yield is 0.75%, but they do pay dividends and consistently raise those dividend payments every year. Microsoft's been averaging 10% increases, has a 5-year CAGR of dividend growth of 10.2%. But the only way you can pay a reliable and growing dividend payment is by having a great cash generating business. And there's a lot more to stock analysis than just dividends. Microsoft has fantastic earnings growth, and analysts are expecting this to continue well into the future. So I very much am a believer in the growth side of investing. And if a company is doubling its earnings every 5 years, that is bound to lead to value creation for investors, as long as you're not paying too high of a price. And believe me, this has not all been winners along the way. I've taken a lot of losses. Many of you watched me lose a lot of money on Disney. AT&T was an early loss as well. But you gotta keep playing the game and learning. Now, throughout this, I've rattled off a lot of different stats, whether it's yield, dividend payouts, growth rates, etc. If you've ever tried to track all of this in a spreadsheet, you know it's a nightmare. You have to manually update the data, go to a bunch of different websites. It's always a pain. And this is one of the main reasons why I built dividenddata.com. Portfolio tracking is one of our core features. You can manually add your buys or automatically link your brokerage, and you can instantly get a look at your projected dividend income. And that can be across all your accounts if you have many accounts. And since this video is dropping on Black Friday, you can get access to our Black Friday deal, which is the best price we ever offer. You can lock in 50% off annual membership and keep that discounted price for life. You'll get the portfolio tracker plus our stock research tools. We have 30 plus years of stock financials for every key metric you would want to look at, and data visualizations that instantly let you understand the trends. This tool has helped me find winners like Google, like Microsoft, and understand how the real business is growing while the market simply doesn't get it. To get the Black Friday sale, click the link at the top of the description and pinned comment of the video. Don't wait, the sale is going to end soon. All right, so that's enough about dividends. I also buy growth stocks pretty frequently. So we're going to take a look at my non-dividend account and my Roth IRA. And in these accounts, that was a big reason why I was able to hit $397K this year. Let's start with my non-dividend account. This was actually my first investment account, and it's completely crushed it. That is largely due to one of my buys, which was actually one of my first individual stock buys, and I've held it this entire time. That was 75 shares of Tesla, which I spent a little over $1,100 to buy, and that has resulted in over $30,000 of gains. Now, every single time I see this holding, it also reminds me of one of my bigger mistakes, which was in 2019, 3 years later. I had $10,000 sitting on the sidelines, and Tesla stock was trading at the exact same price I had bought it at in 2016. And I was telling people to buy it. I was telling my dad to buy it. I did not follow my own advice, though, and buy Tesla stock. And if I had done this, this would be worth over $300,000. And that goes to say, there's one of those old Warren Buffett quotes, your greatest mistakes are usually mistakes of omission, not commission, meaning sitting one out and not taking action was actually a bigger mistake here. My other holdings I have in this account are Amazon, which I had bought. When did I buy that? I think I was a freshman in college when I bought that stock. Spent $2.6 thousand. I have a 245% total return on it. Around that same time, I also bought Berkshire Hathaway. That's Warren Buffett's company. 136% total return there. And I actually used to own more of this. I actually trimmed it this year and put part of it into Hess Midstream, which I was discussing earlier. So this account has crushed the market, and I don't do anything. I have not had any transactions aside from trimming Berkshire Hathaway since like 2018, I think. Now, of course, if I start to feel uncomfortable about the directions or businesses or valuations of these stocks, I would sell them, but I do not. And by the way, this isn't a full stock analysis video. I'm not going to dive into each of them. So now let's go into my Roth IRA, which has pretty similar growth names. I only own 2 stocks in this account, Tesla and Google. And unlike my original Tesla position, this one was all purchased in the past 2 or 3 years. My cost per share, $143, $37,000 of gains. If we take a look at Tesla stock, it's extremely volatile. And at times it's definitely overvalued, and at times it's very undervalued. And at times there are massive sell-offs. So I think I first added to this in my Roth IRA. I think it was at the beginning of 2023, and it was selling off a ton then because we were in the tech crash following the interest rate increases. Plus at that time, Elon had just bought Twitter, and I believe he had to sell some Tesla stock. So all of like the warning signs were going off. People were so scared. And I just used that as an opportunity to add. And by the way, this stock is a great example of a complete roller coaster. And then I'm pretty sure when I add the second time, it was during that spring 2024 period. The other holding in this account is Alphabet, ticker symbol GOOGL. This is the parent company of Google. I have about $7,000. Purchased this around early 2025. Have a 106% total return on the position. And that brings us back to the overall combined accounts. Tesla's my largest position, followed by Hess Midstream, Microsoft, Google, Visa. So this is where I stand today. Total value just over $397,000. But what would happen if I never added another dollar to this account? I just let the market do its thing for 30 plus years. What happens? Well, on dividenddata.com, I have some bonus tools. That includes this dividend snowball calculator to forecast 35 years of compounding. It's meant for one stock, but we can hack it a little bit to have the whole portfolio projected. So I put the current stock price as my whole portfolio and annual dividend as my annual dividends. Let's say I bought one share of this account, and I expect my dividends to grow annually at around 7%. And let's say stock price compound annual growth rate of 10%. I'm going to reinvest those dividends the whole time, and I'm going to add no new money. So what would happen? In 30 years, by the time I'm 56 years old, this account would be valued at $13.7 million. And it would be earning $149.5 thousand in annual dividend income. Again, this is assuming I reinvest all of my dividends. Now, the interesting thing is if you just wait another 5 years, that account will grow by nearly $10 million to $23.7 million. And it would be paying me $221,000 a year in dividends. And that's because the most important factor when you're investing is time. The longer you can let your investments compound, the better. Time in the market is the most important thing, so you just have to get started. And that includes your time reinvesting dividends. As you can see, if you took that all as cash, your total value would be far less by the end. It's a more than $10 million gap over 35 years. So with that said, I hope you all had a great Thanksgiving weekend. And I'm grateful to be in the position that I am. And I'm also grateful for all of you watching me along my journey. And especially those of you who have supported me in creating dividenddata.com and helping me create tools that provide value to you guys. But really, the most important thing to remember here is that everyone's day one looks different. You should not be comparing yourself to me or others. By the aggregate statistics, there's likely many of you watching this video who maybe started investing later or haven't started at all. You can't compare yourself to others. You'll drive yourself crazy. The real thing is just to start. Even me, I find myself in that trap all the time. There's always someone making way more money than you, either through their job, business, or investments. You will drive yourself crazy if you're always comparing yourself to others. Everyone is running their own race. All you can do is take action to improve your own situation. Nothing I gave in this video is personalized financial advice. You should always do your own research before making any investing decisions. And that's why I built this great tool to help you do stock research. If you're interested, check out our Black Friday sale. It's the best deal we ever offer. And if it helps you find just one better stock, then it way more than pays for itself. I hope you enjoyed this video. Leave a like, comment, and subscribe if you did. And with that said, I'll see you in the next one.